Good day everyone, especially to our instructor, Sir Alvin Lentejas. My name is Strawberry Hawk, a IS202 student, and today we will be presenting our last topic, which is the sources of long-term financing. To understand it better, when we say long-term, it takes a period longer than 1 year. So in business, it applies to plans, goals, or financing. While financing is getting money to pay for things a business need, it can come from loans, investors, or other sources. Long-term financing provides money for a business to buy essential assets for over a year. So long-term financing, to understand it better, is a money a business borrow to pay for big items it needs like essential assets. So when we say essential assets, these are your ari-arian. These assets are important to things a business needs to operate and grow. Also necessary for the business to run effectively and also make a profit. So now that we already know the meaning of long-term financing, now we are going to talk about the major sources of long-term financing. So for the first one, we have equity financing. So again, when we say equity, it represents the value of the owner's share after all the debts are paid, after ang mga tanan na utang na baydan. So equity financing is when a business raises money by selling shares. Investors who buy shares become part owners of the business. No repayment is required, but profits may be shared. So in short, to understand it better, equity financing is the process of raising capital through the sale of shares. It helps fund businesses' growth without adding any debt or utang. As what you can see here in the illustration, to understand it better, companies sell shares to investors so that both the company and the investors can raise funds. So to understand better, here is an example of an equity financing. So let's use the example of SM Investments. So SM Investments Corporation sells their shares on the Philippine Stock Exchange or PSE. They use the money from selling shares to build new malls and expand their business. So ang Philippine Stock Exchange, sila ang nagpa-facilitate on the buying and selling of securities. So this includes stocks and bonds. This allows investors to trade these financial instruments. So this is how equity financing works. First, by selling shares. So companies raise funds by selling shares, which gives investors ownerships in the company. So example, if you buy 10 shares for 1,000 pesos each, 10 shares total to 10,000 pesos each. Tapos later, i-decide na ibaligyan mo into 1,500 each, you make a profit of 5,000 pesos. So next is ownership. So by buying shares, gives investors ownership and voting rights in the company decisions. So example, if you buy 1,000 shares of a company that has a total of 100,000 shares, you own 1% of the company. So when investors buy shares, they gain ownership rights in the company. So this often includes voting rights on important company decisions, such as electing the board of directors. Third is by profit sharing. So companies share profits with shareholders through dividends. So when we say dividends, these are the payments made to shareholders from a company's profit. So example, if a company earns a profit and decides to pay a dividend of 5 pesos per share and you own 200 shares, you would receive, here's the computation below, 200 shares times 5 pesos equals to 1,000 pesos in dividends. And lastly, we have value appreciation. So if a company grows its shares price may increase, allowing shareholders to sell for a profit. So example, if you buy 1,000 shares at 10 pesos, total of 10,000 pesos each, if the share price rises to 15, you can sell your shares for 15,000 pesos, making a profit of 5,000 pesos. So parang shares lang din siya. That's how it works. So now we are going to talk about the types of equity financing. So for the first one, we have public equity. So companies raise money by selling shares to the public during an initial IPO on a stock exchange. So for short, this is the ownership in a company through shares sold to the public. So to understand better, IPO is a way for a company to transition from private to public ownership, providing access to a wider pool of investors. So while stock exchange, bagan PSE example, again, siya ni siya nagpa-facilitate on buying and selling of company shares, making it easier sa mga investors nga makaparticipate sa market. So for example, we have here PLDT. So PLDT is a leading telecommunications and digital service provider here in the Philippines. So PLDT is publicly listed sa PSE. It enables shareholders to invest in the company. Next is we have Ayala Corporation, one of the largest and the oldest corporations here in the Philippines. So it also involved in various sectors such as mga real estate, banking, telecommunications, and utilities. So also its shares are traded on the PSE, Philippine Stock Exchange. Lastly, we have Jollibee Foods Corporation. Known for its fast food restaurants, Jollibee is a popular brand here in the Philippines and is also publicly traded on the PSE, offering shares also to investors. Second is we have private equity. So companies raise money by selling shares to private investors such as venture capitalists or often equity firms to fund startups or smaller businesses. So when we say venture capitalists, these are investors who gives money to new or growing companies in exchange for part of ownership, expecting the business to grow and make money. So an example of venture capitalist is a new Filipino food delivery app, hoping it becomes successful and also profitable. So an example here in the Philippines of a private equity is Kumo, a popular Filipino live streaming app. Received investment from private equity firms like Open Space Ventures and SIG. So these investors provided funding to help Kumu grow and expand its services. Third type of equity financing are angel investors. So angel investors are wealthy people who invest in startups for part ownership and may also offer guidance. So sample here in the Philippines is Joey Concepcion, founder of Go Negosyo. He has invested in and mentored local startups, supporting their growth for providing funding and businesses advice. So the fourth type of equity financing is the crowdfunding. So crowdfunding are companies that gather small investments from many people online, sometimes giving back ownership shares. So an example here in the Philippines is a Filipino social enterprise that raises funds through a platform like Spark Project, where many Filipino invest small amounts to support its mission and in some cases get a share in the company. The second source of long-term financing is debt financing. So this is when a company borrows money and agrees to repay it with interest, often through bank loans or bonds. So how does debt financing works? So first, by borrowing money. So a company borrows money from a bank or sells bonds to investors, promising to repay it with interest. So to understand it better is an example of debt financing here in the Philippines is when SM Investments Corporation issued bonds to raise funds for expansion. Investors bought these bonds and SM promised to repay them with interest over time. So the second one is repayment terms. So this is when a company borrows money. It agrees with the bank on how much to pay back each month or year, the loan duration, and the interest rate. So an example to understand it better is Philippine Airlines took out a loan to purchase a new aircraft. So they agreed with the bank on monthly repayments over several years, with an interest rate included in the terms of the loan. So there are two types of debt financing. First is we have loans. So loans are money that are borrowed from a bank to be repaid with interest. Loans can be secured, backed by assets, or unsecured, meaning no assets. So an example to understand it better is Jollibee Foods Corporation. They secured a loan from a bank to fund its expansion and store development. The loan was backed by assets like its existing properties. The second type are bonds. So bonds are companies or cities that issues bonds, IOUs, to raise money, promising to repay with interest. So to understand it better, IOU stands for I own you. So IOU is a written promise to repay a debt. It's an informal note saying one person owes money to another. Bonds are formal type of IOU. So an example to understand it better is Metro Manila Development Authority or MMDA. They issued bonds to raise funds for infrastructure projects like road improvements. Investors bought these bonds and MMDA promised to repay with interest over time. So the third type of long-term financing is retained earnings. So retained earnings are profits a company keeps to grow the business or pay off debts instead of giving them as dividends to shareholders. So when we say retained, it means to keep or save, not given out or away. So this money is used to help the business grow or pay off debts. So how does the retained earnings work? So first is calculation of retained earnings. So the retained earnings formula is retained earnings equals previous retained earnings plus net income minus dividends paid. So to understand it better, when we say previous retained earnings, these are the amounts saved from profits at the end of last year. While net income, we already know that is the profit left after subtracting all the expenses from revenue. Then dividends paid are the money given to shareholders, lowering the amount the company money keeps. So for example, imagine a small cafe in Calbayog. So let's use Binder Cafe for example. So let's say last year, Binder Cafe had 150,000 pesos saved as retained earnings. That is the profits at the end of the last year. So this year, the cafe earned, let's say, 60,000 pesos, but paid 15,000 pesos in dividends to the owners. So to find the new retained earnings, so retained earnings is equals to 150,000 pesos plus 60,000 pesos minus 15,000 pesos equals to 195,000 pesos. So by the end of the year, Binder Cafe has 195,000 pesos kept as retained earnings to grow the business or let's say pay off debts. So second is the purpose of retained earnings. So companies use retained earnings for first, we have reinvesting. So funding new projects or expanding the business. Next is paying debts, paying off loans or other obligations. The third one is financial security, which keeping money for future needs or emergencies. So the fourth type of source of long-term financing is we have leasing. So leasing allows businesses to use equipment or property without buying it. So instead of paying a big amount upfront, the business pays a fixed amount regularly or usually monthly to use the asset for a set of time. So when we say lease, it is a contract to rent something for a set time in exchange for regular payments. So to further understand what leasing is, let's give you an example. Like for example is leasing equipment. So Hemasuto Builders here in Calbayog needs a crane but doesn't want to buy it. So they lease it for 12 months at 50,000 pesos per month, saving on upfront costs. Other example is, let's say, leasing office space. So Paymaya, a tech company, needs office space but can afford to buy property. So they lease an office for 2 years at 100,000 pesos per month, conserving cash for business growth. So how does leasing works? So the first one is we have lease agreement. So a lease agreement is a contract between the owner, the lessor, and the user, the lessee, that specifies the rental period and payment amount. So to understand it better, for example, is Honda Cars here in the Philippines, which offers vehicles leasing to businesses. A company can lease a car for 3 years, paying a fixed monthly amount, allowing them to use the car without buying it. So the second one is we have two types of leases. So for the first one, we have operating lease. So when we say operating lease, this is a short-term lease where the lessee can return the asset or renew the lease at the end. So an example to this is the PBB or Philippine Business Bank. So they offer vehicle leasing. A company may lease a vehicle for 3 years, and at the end of the lease, the company can either return the vehicle or extend the lease. So for the second one, we have capital lease. This one is a long-term lease that works like a loan, where the lessee can often buy the asset at the end for a set price. So for example is the BPI, Leasing Finance Corporation. So they offer financing for businesses to lease equipment like trucks or machinery. For instance, a company may lease a delivery truck for 5 years with the option to purchase it at the end of the lease for a fixed price. So for the fifth type of sources of long-term financing, we have convertible debt. So this is a loan that can be converted into shares of the company's stock instead of being paid back in cash. So when we say convertible, this means something that can be changed into a different form. So in finance, it refers to a loan or bond that can be converted into company shares instead of being repaid in cash. So this means instead of getting paid back in cash, the lender can get company shares and become a part owner. So to understand it better, let's say an example again of convertible debt is SM Investments Corporations. So the company issued convertible bonds allowing investors to lend money to SM but with the option to convert the debt into SM shares after a period of time. So this allows the company to raise funds without immediately giving up ownership. So and investors as well have the potential to benefit from the company's growth by converting their debt into stock. As convertible debt works, to understand it better, we have first a loan agreement. So a loan agreement is a contract where a company borrows money and agrees on the amount, interest, and when to pay it back. So let's say an example, a local business here in Calbayog like a restaurant takes a loan from Land Bank of the Philippines. So they agree to borrow 50,000 pesos with an interest rate of 8% per year and a repayment term of 5 years. So the terms are outlined in the loan agreement. Next one is we have the conversion option. So let's the lender change the loan into a company shares later, usually when the company grows. So let's say an example is the First Gen Corporation. So this is a large energy company here in the Philippines. So they offer convertible debt into investors. Instead of paying back the loan in cash, the company allows lender to convert their loan into shares of the company's stock once the company grows and the shares increase in value. So for the third type, we have conversion terms. So this is the agreement that explains how the loan can be turned into shares. So this includes how many shares the loans equals and any conditions that must be met. So let's say an example of Globe Telecom. They offer convertible bonds with terms saying that for every 10,000 pesos bond, an investor can get 100 shares of Globe after 3 years, but only if the company meets a certain goal. So for the last source of long-term financing, we have securitization. So this is when a company combines financial assets like loans or receivables and turn them into securities or financial products. So to understand this, these are sold to investors, allowing the company to get cash upfront by selling the right to collect future payments from those assets. So for example, to understand it better is let's say BDO Unibank. So, BDO Unibank groups home loans from its customers and turns them into securities. So, these are sold to investors who get the interest payment from the loans. So, BDO receives cash upfront to use for other projects. So there are four types on how securitization works. So first we have pooling of assets. So when we say pooling of assets, a company combines various financial assets like home loans or credit card payments into one large pool. So for example again, let's use BPI Capital Corporation. So BPI may pull together home loans from BPI Family Savings Bank and then turn them into securities, which are sold to investors to raise funds. Second is we have creating securities. So when we say creating securities, the company creates securities like bonds from pooled assets representing a share of future loan payments. So for example, we have PNB or Philippine National Bank. They might create securities from a pool of home loans and sell them to investors who receives a share of the future loan payments. So the third type is selling to investors. So the company sells securities to investors who will receive future loan apps. So in return, the company gets an immediate lump sum of cash. So for example is the Ayala Land. So Ayala Land may pull together property loans and create securities. These securities are then sold to investors who will receive payments from the property loans over time. So in return, Ayala Land gets a lump of cash to fund new projects. So for the last one, we have investors earn interest. So investors earn money from the interest on the loans in the pool, while the company no longer collects the payments. So example again is Metrobank. They create securities from a pool of car loans and then sells them to investors. Investors earns interest from car loan payments while Metrobank no longer collects those payments. So to sum it all up, long-term financing helps businesses get steady money for growth, makes payments easier, and keeps cash for daily needs. But it also has some downsides, like higher interest costs, the risk of losing assets, and less freedom to adjust financially. But knowing all of this helps businesses make better choices for their future. So that is all for Group 5. Thank you for listening. Bye!